Well, hello and welcome back to Jones Financial Talk. This is Nick Jones from Jones and Associates Premier Financial Solutions. Listeners, if you'd like more information about what you hear on this awesome show today with Mr. Tony Shore, you can do that in two ways. You can go to our website at jonesfinancialtalk.com, click on the radio page. You can even download our programs on great mediums like Spotify. You could also give us a call if you have any questions at 541 500 4321. Once again, that's 541 500 4321. Now, listeners, it's the holiday season, and I want to talk today a little bit about charitable giving and how to do it correctly because many of my clients ask me lots of questions about how to give to charity effectively with their finances. And so I thought that would be a great topic today. But, Mr. Shore, how are you doing, my friend?
I am doing great, Nick. I've been good. I had a great Thanksgiving last week. I ate too much, as always, right? I mean, that
Always
happens.
happens. Me too.
That happens, but had a good time. Got to see my parents. That was fun. How about you? What did you do for the holiday last week?
I went out of town and visited some family as well, down to
Nice.
California. It was a great
Yeah.
time, nice and warm, a little different than here in Oregon. But no, we had a great time. And now I'm trying to lose a few pounds before we started again for Christmas.
I know. You and me both. I always tell myself this year I'm not going to eat as much, but you know what happens. You see all that food there. It's just, oh, and you got whoever cooked it is always telling me, you got to have some more. You got to try this. So,
Eat it all because they don't want leftovers.
nope, nope. Although I have been enjoying the leftovers. I love the turkey sandwich. And yeah, yep, I love leftover turkey. So, got my fill of that. And you had a good Thanksgiving. I assume you went down to Sacramento, is it?
That's exactly where we went. Yep.
Yeah.
Go see
Yeah.
some old family friends. Yep.
Love Sacramento. Yep. Yep. My good buddy Mike Rowe, one of the greatest guitar players ever, lives there. He's a great Michael Rowe. He was in a band on Island Records called the 77s. Just a little trivia for the
Nice.
kids out there.
Nice.
Anyway, we're talking about charitable giving today. Where would you like to begin with this topic, Nick?
Sure. So a lot of people ask me, where to start with charitable giving and when they're thinking about their finances. And, assets that are in individual retirement accounts are really the best assets to give away to charity because they're just loaded with taxes, Tony. And so, for those who give, regardless, using something like their IRA to make those gifts can provide some significant tax benefits only if it's done correctly, which is the point of the show today. Okay. And if not, then lots of those tax benefits can be lost. And so this is through what's called a qualified charitable distribution.
Okay. So you call that, I've heard that term QCD thrown around.
Yes.
And why don't you explain what a QCD is for our listeners out there, Nick?
Okay. So a QCD, which is called a qualified charitable distribution, is really the best way for IRA owners to receive some tax benefits for their donations. And QCDs are done by making a direct transfer. That's very, very important. A direct transfer from their IRA to a qualifying charity. And that tax benefit, is the distribution from the IRA, and it's not included in income. Otherwise, it would be if you just took the money out, obviously.
So number one, you don't have to pay taxes in a traditional IRA if you make a QCD. If you donate to a charity or tithe to a church, and it can go directly from your traditional IRA to that organization. You don't have to pay tax on that money, is what you're saying. And it doesn't count toward your taxable income. So it's not going to raise you into a higher tax bracket, might help your tax burden there, lower your tax burden by, keeping you in a lower bracket or putting you in a lower bracket. So I think that really sounds like a great thing. Now, a lot of people out there tithe to their churches.
You're exactly right.
And I think a lot of people donate to charities if they have the money. And I know a lot of seniors that like to give to their church or donate to charities. And I think most of them just write a check
Yep.
out of their bank account, checking account. But that they're making a huge mistake and they're losing money by doing that, then, is what you're saying, if they have a traditional IRA.
That's right. I mean, this is just another planning step and tool that you should be talking with your advisor about throughout the year when you're considering taking distributions out of your IRA. And more importantly, like we're talking about today, when you're thinking about giving money to charity. Now, Tony, I did mention before, but I really want to make sure I bring this point home. It has to be done directly. The transfer has to be direct from the custodian to the charity, okay, from your IRA. We've got lots of clients that come in and say, "Look, I want to tithe to my church, or I want to give to these three local charities." Perfect.
Yeah.
Your advisor can set up a way for that money to go directly to those charitable organizations, so that you can benefit from this.
Yeah. Well, and that's important. And I think it's really good that you're doing this. Are there any downsides to a QCD or charitable distribution?
Yeah, so the main downside is that charitable distributions or qualified charitable distributions are not allowed and available to everyone. Okay. It's only for IRA owners, traditional IRA owners and beneficiaries who are at least 70 and a half or older. And a very important point here is they
Hmm.
cannot be done from 401ks. It's got to be done from an IRA.
Ah.
You're probably asking me, well, what's up with the 70 and a half? Well, remember, prior to the Secure Act 1.0 and 2.0, before COVID, the RMD age was 70 and a half, right? And so this was similar in the IRS tax code that wasn't really updated. And so anybody that owns an IRA, traditional IRA, or a beneficiary who owns it, who are at least 70 and a half, have the ability to do this, Tony.
Oh, okay. So if our listeners are out there, they're in retirement or they're 70 and a half, maybe they are still working, but most people are retired by then. But if they're still working, if they have that traditional IRA and they're older than 70 and a half, they can utilize this QCD.
That's right. That's right. There is an annual limit that I should talk about here, Tony. So the annual limit is $100,000 per IRA owner. It's not per account, which is sometimes confused. And so properly timed qualified charitable distributions can also offset required minimum distribution income, which we're going to talk about. Now, the required minimum distribution age today, as many of our listeners know, is 73. Okay. But that QCD age, like we talked about, the 70 and a half, has not changed. So many people can still do qualified charitable distributions even before they have that RMD event at the age of 73, soon going to 74 and then 75.
Right. Well, let's talk about RMDs for a minute. Obviously, and I know we're going to talk about this more in a bit, but from what you're saying there, you can satisfy that RMD by doing a charitable distribution. So let's say, hey, I don't want to take an RMD. I don't want to take that required minimum distribution out of my IRA because I don't need that money. But they're going to make you take that, and they're going to make you pay taxes on it unless you use that money for, say, if you give annually to your church 10-15% to your church or to a charity each year, you can just use your RMD for that and not pay taxes on it. So
If you send it directly, which is the key again, right? But you are
yes.
correct, Tony. So that brings up a great planning point that you better be talking to your advisor about.
Yeah, I
What
would not
happens?
want to do this. You need an advisor like yourself. You have to work with a financial professional to make sure you're not making critical mistakes. If you're going to do this, you have to have a professional in your corner to make sure that you're in a situation where it benefits you and to make sure it's done correctly. But can't people just deduct charitable donations? I mean, people might be thinking, why do I need this QCD? Can't I just write a check from my bank account and then deduct it from my taxes?
And interestingly, Tony, I've had lots of clients that have taken distributions from their IRAs, not thinking that they should send it directly for whatever reason, and then just write a check. And they obviously have thought, well, don't I just get a charitable donation for doing that? But if you think back to 2017 when Trump changed a lot of the tax code, most people really no longer receive tax benefits for their charitable gifts. And the reason
Yep.
is because over 90% of taxpayers today don't even itemize their deductions, right? Instead, they use the higher standard deduction, which For those of you who don't know, this year in 2023, anybody over the age of 65, you're going to get almost a $31,000, deduction.
Standard
Standard
deduction. It's called the
deduction
standard deduction.
if
Yeah.
you're married and you're filing jointly, or individually, almost 16,000 for single individuals. So the point is, if you're not giving at least that much away and have that much of a deduction with other things, you're not even in the realm of getting a deduction for helping with those charitable contributions. So a very, very important point. Now, a qualified charitable distribution provides a tax benefit even for people who take that standard deduction, because it doesn't count as adjusted gross income. That's the
That's the
main
key.
point.
Yeah.
Okay.
That's the key right there. It doesn't count on that line for adjustable gross income. So it won't affect your tax situation. It won't be taxed. And that's beneficial in other areas. You want to keep that. Typically, you want your adjustable gross income to be as low as possible, because then you can qualify for other things from the
Well,
government if you have a lower AGI, right?
and we've talked about that on the show with many occasions. When I sit down with clients and try to figure out distributions for the year that they're going to take and how it's going to work, the conversation always comes back to what's the adjusted gross income going to end up being, because
Yes.
that is exactly where we can figure out how to continue to do things that are important that we've talked about on the show. Roth conversions, for one, or other things that affect seniors in so many ways that they don't think about. I was recently reading last week kind of the pitfalls of Medicare planning. And in Medicare, there are multiple levels of what you're going to be charged for Medicare costs next year, depending on what your income was the year before. And there's lots of tiny little nuances that if you don't catch them correctly, it affects your adjusted gross income, which what could do what? Increase your Medicare premiums for an additional year or two. And so you got to sit down with somebody and talk about that to figure these specific tax situations out, Tony. You're on mute.
That's the beauty of what you're of a QCD, from what you're telling us, Nick, is that it can lower that, help you keep that adjustable gross income lower. And that's a good thing. I mean, that might help you pay less for Medicare premiums, things like that. So it really can affect a lot of other things. Now, how can you mess up a QCD? I know this isn't something you want to go it alone figuring out. You need a professional, but why? How can a person mess up a QCD?
Okay, so there's lots of great tax benefits from using a QCD, but it can be forfeited very, very easily if you just don't follow the rules. And this happens a lot, unfortunately, at the end of the year, because people are in a rush to make sure that they're coming up against that year-end deadline when things have to happen in the calendar year. And so there's just lots of things. The first thing I'd mention, Tony, is a timing error. Okay. And so one of the key benefits of using the qualified charitable distributions is that the distribution from the IRA to the charity, isn't included in income and can satisfy your RMD amount, like we talked about. So if you have already taken some of your RMD throughout the year, though, you can't just, take off the qualified charitable deduction to offset the RMD income. It still will be excluded from your income. But if you've already taken a required minimum distribution throughout the year, that's going to be included in your income. And so if you want to avoid that result, you want to make sure that you do the qualified charitable distribution first before you take your RMD. And that's what I mean when I say it's not good enough to just sit down with your advisor at the end of each year and figure out what to do for tax planning in the fourth quarter. And the reason for that is things like this come up. If I know that clients want to take a qualified charitable distribution throughout the year, we need to address that first before we get to the required minimum distributions. Otherwise, they're going to have to take more money out and be taxed more heavily by doing it in the opposite fashion or opposite order of what would be more beneficial to them tax wise.
Yeah. Well, you make a great point there. And before we go on, Nick, I want to take a quick moment here to let our listeners know about a special offer that you have for them. You're willing to sit down, answer any questions they have. They can meet with you or your staff there. All they have to do to set up that no charge, no obligation consultation is go to jonesfinancialtalk.com, correct?
That's right. Or they could also just give us a call at 541 500 4321. We get calls in from the radio shows all the time, and I love talking to prospects. I love talking to clients. I love talking to people that just listen to the radio show that have specific questions. It keeps me sharp, and it gives me new ideas and topics to discuss with you all. So please take us up on that offer.
All right. And I think we should take another minute to reiterate that phone number. It is a new phone number. I want to let our listeners know there's a new phone number to contact Jones and Associates. That's 541 500 4321. And again, the web address is Jones Financial Talk. Now, let's talk about how to avoid some pitfalls with QCDs or some more information that our listeners need to know about charitable distributions.
Okay, so the other next one or big one to bring up, Tony, is waiting until your RMDs begin. I mean, the reason why this is confusing is before COVID and before the CARES Act came out, CARES Act 1 and 2.0, the RMD age was in line with the qualified charitable distribution age, which was 70 and a half. Okay.
Yep.
And so a
Love
lot
that
of
half age, by the way. Thank you, IRS and
it's
government,
it's
for
amazing when we come up with these little things in the tax code, right? But
yeah. We don't
so
celebrate half birthdays, Nick. I mean, that's not
some
since
people
we were
do. Some people
not
do,
since
but
we were 5, and so why the
uh,
IRS? There's no such thing as a half birthday. So yeah.
but as a result of that, many IRA owners are confused and they think that they can't do any kind of qualified charitable distributions until their RMD age begins at the age of 73. Right. That's false. The QCD age is still 70 and a half.
Wow.
And if you want to continue to give money to charities, you would be missing out on a few years if you don't do that before your RMD age begins. And so that's just lost tax benefits for donations that you're going to make anyway. So again, another topic to be aware of and talk with people about.
Yeah. Well, I'm glad you brought that up. It is until this show today, I did not know that until looking at some notes and talking to you. I thought qualified charitable distributions or QCDs were only took effect once your required minimum distributions took effect, and they gave you that option to help you out with those. But because of the new law, the way it's worded, you can start doing QCDs when you're 70 and a half, even though that RMD age has been raised to 73, just to put it succinctly, right? Is
Yep,
that what you're saying?
that is correct.
That's huge. Yeah.
And another big thing, Tony, that happened when the Secure Act came out is it removed the restrictions against making traditional IRA contributions after the age of 70 and a half. And so this is a big one for people
Mm,
to consider as well, because an IRA deduction can invalidate the qualified charitable deduction benefit. And
mm,
so I have an example that we can talk through. For example, if a person made a deductible IRA contribution of say $7,500 this year in 2023, and also did a $10,000 qualified charitable distribution, only $2,500 of that qualified charitable distribution would be excluded from their income. Okay, the remaining 7,500 would be a taxable qualified charitable distribution, and it would eliminate that tax benefit. So any amount of the QCD that's not allowed can still be taken as an itemized deduction. However, like we talked about earlier in the show, tons of people do not itemize their deductions, and so that's not something that's helpful to them.
mm.
The better option for those who wish to use that qualified charitable distribution is to not make a taxable or a tax deductible IRA contribution. Instead, take that money and contribute it to a Roth IRA. Okay. And if income is above the Roth IRA contribution limits, then talk to your advisor about using the backdoor Roth IRA. where a contribution is made to a non-deductible traditional IRA and then maybe converted to a Roth IRA.
Ah,
So
okay.
the point here is there's lots of little nuances in something that is so good. We want clients and people to give money to charities, and we want to entice them by giving them a good tax benefit. But if you don't follow a bunch of these very simple kind of rules with the IRS's current code, it's not going to be beneficial for you.
Yeah, and
So,
you've just illustrated throughout this show a huge reason why it's beneficial to work with a financial services professional. I mean, somebody like yourself, Nick, if somebody works with your office, you have all the professionals there that can help people with every aspect of their financial planning and retirement planning. And this is a big one because you can easily make mistakes with this, or you can just simply be going along, and, tithing to your church, not realizing, and you're using after tax money when you could be using pre-tax money and saving that amount. So that's a big deal, and you could be lowering again your adjusted gross income, which is going to help you save money in other areas and help you qualify for other benefits. So it can snowball the amount of money you can save. But like you said, the IRS tax code, it gets crazy and it's constantly changing. You got to have somebody in your corner
yep.
that stays up to date on this. And I know you're constantly staying up to date with Ed Slot seminars and meeting with other advisors, talking this through, looking at what's changing in the tax codes because they're constantly changing. So working alongside tax professionals, right? So I think that's really smart. People need to be aware of this.
Yep. Yep. And there's a couple of other specific questions that some of my clients have asked me along the way. One thing that has changed a lot in the tax code over the last couple of years, Tony, is beneficiary IRAs, right? When somebody passes away and you inherit their IRA and how that is affected. And so I wanted to at least cover in
Yeah,
this
let's
specific case, when
sure.
you think about beneficiary IRAs, they can qualify for for qualified charitable distributions, but they also must be that age of 70 and a half. This is something that a lot of people are confused about because in many situations, when you inherit an IRA from somebody, you are forced to take that money out over a specific amount of time.
Hmm.
And the fact that possibly the deceased person of that IRA, was over the age of 70 and a half at death and was already making qualified charitable distributions that they wanted you to continue, it has no bearing on this.
Hmm.
If a beneficiary attempts one of these QCDs before they are actually the age of 70 and a half, it won't qualify and it will not be excluded from the income that they pull out of that IRA. And so it's extremely important to make sure that you understand all of these little differences, to make sure that you're taking advantage of that. Now, this comes up a lot because lots of times people inherit money from their parents, and their parents' intentions were to give that money away to charity, and they want to continue their legacy that way, right? This is a specific situation that I've dealt with a lot, and so you just got to make sure that you understand that. Otherwise, at the end of the year, you've done something great, but then you get hit with an extra tax burden bill that you didn't expect. Um, you added a little bit of insult to injury for trying to do something that was right.
Hmm. Yeah, and that's not good. You don't want to leave your loved ones with a mess. You want to make sure this is all tied up. And if you're inheriting a traditional IRA, you want to make sure you understand how that works. And I get confused on what happens, or there's so many negatives about inheritance where you can really get socked with a lot of costly taxes and things like that. So again, that's where I rely heavily on you, Nick, to really help out. I know this is something you help your clients out with and can help our listeners out with. But the beneficiary QCD, that's an interesting concept too. I'm glad we're talking about that.
And then the other thing that I think I just mentioned also, Tony, and you're right, it's the two states that we live in, Minnesota and Oregon, have lots of tax code, and
Yes.
more than most other states. Okay,
Yeah.
and so that's why we talk about this so much on our shows. But The other thing I wanted to mention about qualified charitable distributions is there can't be any benefit that goes back to the person that makes the donation. What I mean by that is, if you're the donor to give money to a charity, you can't get something like tickets to a show or dinners or discounts in return, or some other intangible benefit or title for the contributions that you're making.
Sure.
So that you just have to understand that clearly, and I think most people probably do, but some people can get caught up in that. That's a difficult one because people want to be acknowledged for what they're doing, and they like that. But you just got to be careful of how that kind of plays out, if that makes sense.
Yeah, that's something I've never thought about, but you're right. And of course, the IRS is really a stickler on that. If you donate something and write it off your taxes and you're receiving a benefit for that donation, they can come after you because, yeah, that is a no-no. And I think most people realize that, but it's easy to say, hey, I contributed a lot to this charity, so they invite me to this big thing, or they might have a cruise or something. And so you got to be really careful about that. Yeah.
Yep. Yep. Um, Charitable giving is so important in every community, especially the Rogue Valley. And this is the
Yeah.
time of year when we try to do a lot for the community. We do it throughout the year as well, but we do great things, during the holiday season. And so I think it's just important to make sure that you're talking with your advisor about the different options that you have, and don't do it when it's too late. The last month in December. December is the busiest month for custodians for processing things like charitable distributions, as well as Roth conversions and things of that nature. So plan. The idea here is you should be sitting down with your advisor multiple times a year. And if these are topics that interest you, they should be on your agenda, and they should be answered and on your advisor's agenda to make sure that they take place before you get too far along in the year, if that makes sense, Tony.
Sure. That makes perfect sense, Nick. And this has been a great topic. I think it's interesting. I think there's a lot here that people probably don't realize. I really think that it can get complicated. We can get deep in the weeds, but that is why you have resources. And I want to encourage our listeners to go out to jonesfinancialtalk.com. They can listen to this show, past shows, look at the topics, pick something they want to hear about, or they can simply contact you through the website. There's a contact form, and then you'll get back to them. You can set up a no charge, no obligation consultation. I want to reiterate that for our listeners. Nick and his staff love to hear from people, help out people. That's what they're there for. And there's no cost or obligation for an initial consultation. Also, you have a book I think you can give
Yep.
folks. Yep. And
Lots of
tell our
what we
listeners.
cover. Yeah, lots of what we cover on the show is also in the short book that I wrote to cover a bunch of these topics. And you could also give us a call, listeners, at 541-500-4321 to request any of that information. That's what we're here for. Thank you very much for listening to our show.
All right. And that does it for today's episode of Jones Financial Talk.